Netflix is going to be one where, a lot of investors are going to kind of queue off of like huge move off the lows, right, from last spring. It's had a really like nice uptrend that's been in place from those levels. It's been very volatile, but again, this is a stock that trades a lot on their fundamentals, right? Like when they give, a guidance for their subscribers or their costs, like that sort of thing. This stock has a tendency of moving 10, 15% or so. 4 quarters ago or 3 or 4 quarters ago, a 35% move lower. Now, since then, it's had a bunch of moves higher, right? So expectations were low enough, and it kept meeting or beating them, and then the stocks had this like 100% plus move off the lows. What's your thoughts here? Because the fundamentals for streaming in general have gotten a lot trickier. I think they got washed out last year, right, in a very recessionary environment, in a bear market where high valuation names, where they saw deceleration, got killed. It feels like a different market right now.
Right. I mean, just conceptually, there's nothing more dynamic or potentially rewarding or risky than a high-flying, large-cap growth technology stock, call it Meta and Netflix, that stumbles, that then recovers, right? There is no greater dynamic in markets. And that's exactly what we see here and what we know Netflix. A great winner that basically collapsed, drops and gaps, earnings related, that's now been on the mend for a long time, which is to say we know the market bottoms in June, all equities, but they make new lows in October, and Netflix never looked back. Let's put some lines in. We can use moving average, 150-day moving average. The stock is checked back to it, bounced. But the bounce, while good, is starting to falter. My own thinking here is that we revisit the 150-day. You can also put in trend lines. And that is the point of a moving average, is to try to mirror a trend line. But I think we're going to get, my bet is lower here, and we get down to that well-defined uptrend line in effect since the June low.
Yeah, and my 2 cents on that is that I think a lot of the good fundamental news is kind of in the stock here, and any sort of hiccup on the subscriber front and some of the competitive stuff that I'm seeing kind of leads me to believe that, like we might see a deceleration of some of the trends that caused the stock to have that sort of move off the bottom. And let's just do this as a little exercise right here as we get into the meat of earnings season. You'll hear us on Market Call or on Fast Money talk about implied move in the options market. So how do we figure this out here? Let's look at Netflix. Okay, so it's trading around $330 here. So I would take the at the money straddle. That is the call premium and the put premium in the weekly option. Okay, so we have a weekly option that expires this Friday on April 21st. With the stock at 330, the at the money call is about $15. The at the money put, the 330 put, about $15. You put that together, that's 30. You divide by the strike price, it gets you about 9%. So if you were to buy volatility in Netflix, let's say you did not have a view whether it was going to go up or down, okay, you could buy the straddle and you could hope for a move at least to 330 plus the 30 in premium that you paid. So that would be 360 or higher by Friday's close. Or the flip side of that, it would be $30 less the strike, which is 330. So it gets you down to $300. If you look at that, that's the range that's implied by the options market between now and Friday's close. Let's look at it on a 1-year chart here. Okay. And so you see that it really is this kind of it's encapsulating this period that it's been in over the last, call it, month or two or so. So that is a really high implied move. But like I said, the stock on average over the last 4 quarters has moved about 16%, and which is kind of skewed by a 35% move in one direction. Why do we speak about implied moves? Because it's really interesting to kind of get a sense for, if the move is higher than it's been in over the last period or so, whether it's lower. It just gives you a sense for sentiment here. So I just kind of wanted to check in on the implied move. That seems like a lot, and that's one of the reasons why we often say long premium directional trades using options into events like earnings is a really hard way to make money, because the dealers, the market makers, are going to pump up the premiums so they don't get run over prior to that if there is an outsized move one way or another. But to Carter's point before, is that selling premium, and that's what these market makers generally like to do into events. That's how you make money in the options market. All right, Carter, another big one this week. Wednesday, after the close, Tesla, the implied move is about $14 in either direction, or about 7% or so. I know that you've had a couple notes out over the last couple weeks. Let's just kind of check in on this one here and your thoughts.
Sure. I mean, what's important about Tesla, of course, obviously it's a very large cap company, but it's the intersection of so many things. It's consumer. We know this, right? But it's not just going consumer to McDonald's. It's a big purchase, so it speaks to financing and leverage. It's global. It deals with the dollar. It also is animal spirits. It's the single most hated or loved stock in the marketplace with some of the most active options. And so what to do? I think it's going to work lower here, but this channel, sort of the lines draw themselves. There are other ways to do it. Let's look at the next iteration. This is with the 150-day moving average. By all accounts, we know we're in a downtrend and we're struggling as we keep bumping our head up against the 150-day. If we were to really go short term, and you can see that in the next iteration, this is where it all sort of the rubber hits the road, as they speak. We will come out of this formation. It's bullish. It's going up. This is obvious. If it's a bad outcome, it's going down. I've drawn the red arrow. I think we break down here, and so we shall see. But the day-to-day relative performance, the market is poor, and I'm betting against it.
Yeah, so this is one we talk about a lot on Market Call on the Tape podcast, and to me, like, obviously, I'm pretty negative on this thing, and I just think all the price cuts, and they just put through another price cut, right, in the face of a slowing economy and a face of just high inventories as it relates to autos after a period of low supply, high demand. I don't see it, and the stock ran up until the end of last quarter. Because of the excitement about deliveries and maybe making up some market share back in some of the sales that they had lost late last year, through those price cuts. But to me, it really is about margins. And so if we see pressure on their gross margins, that's what this whole story is about. That's why the stock is up 50% on the year, despite it's down from 400, it's trading at $185. To me, I don't find it particularly interesting. If they were to beat margin expectations. I just don't know how they get there, because we just saw their Q1 deliveries. They were lower than expectations with multiple price cuts in there. So to me, might it squeeze? I would look to sell it again if it gapped higher on that. But to me, I think a lot of the good news is in the stock. And I think that, people are kind of loaded up on this one and they're trying to defend it a little bit. I think if margins are worse than expected, I think competition's likely taking its toll. This thing breaks. I think it fills in that gap, Carter, back towards 150, which was that January gap. And that would be kind of my near-term target there.
Yeah. And that's a reasonable downside. I mean, to be clear and to be fair, right? The red arrow is subjective. One could say you could just have drawn a green arrow. Of course, that's why there are people that have buy ratings on Tesla and sell ratings. But a very wise approach would say, don't play, right? A lot of people say this is clearly a moment of equilibrium. The stock is, after collapsing in December, recovering dramatically up from 100 to 200, is basically kind of stuck, going nowhere. Why just have an event-based roll of the dice? Okay, earnings are good, earnings are bad. And so equally good technique is to have no arrows, and green or red, and say, listen, I don't want to play with this thing right now. Let someone else do it. Perfectly valid.
Yeah, and I guess I would just say this. I mean, to me, the risk is that on a better than expected number, the stock gets back towards, let's call it $200. That's in line with the implied move. It's also the downtrend, and that would be, if you want to sit on your hands and wait, I think that might be, if it's a low quality beat, a good place to kind of put something out on the short side.